Today we are diving deeper into Pillar 2 and how this interacts with the regular Dutch corporate income tax system and the incentives. My name is Wouter and once again Tim is joining me.
Thanks, great to be here again. Last time we discussed key considerations for compliance for Pillar 2. Today we're taking it one step further by discussing key features of the Dutch tax regime and Pillar 2, leading to permanent differences and resulting in a lower effective tax rate.
Yeah, that is of course highly relevant. So let's start from there. What are permanent differences?
Well, income can be different for Pillar 2 purposes than it is for corporate income tax purposes, meaning that when you apply a special tax regime, that could lower your taxable profits or lower the tax rate. And that benefit doesn't always translate to Pillar 2. This results into an effective tax rate that could potentially fall under the minimum of 15%, resulting in a top-up tax.
Yeah, so that is quite problematic, of course, because then you have on one hand an advantage for corporate income tax purposes, but that advantage will be neutralized by Pillar 2, so it will not be an advantage in the end.
Right, and a good example of this is the innovation box regime in the Netherlands. So the innovation box regime allows for qualifying innovative profits to be taxed at a lower rate of 9%. And this, of course, is a substantial benefit in comparison to the regular corporate tax rate in the Netherlands of 25.8%, resulting in lower taxes paid, but also a lower effective tax rate.
Yeah, so if the effective tax rate falls below 15%, then a top-up tax based on Pillar 2 will apply. That is, of course, an issue. And the other problem with this is that Pillar 2 doesn't provide for an incentive for research and development activities. And there, Pillar 2 deviates from the regular Dutch corporate income tax system. And in principle, that means that there's no quick fix.
It might be worthwhile to perform an analysis on the substance-based income exclusion, also known as SBIE.
And the same issue we have with the participation exemption, because also the participation exemption deviates between Pillar 2 and the Dutch corporate income tax regime. So, for example, in the Netherlands, we can apply the participation exemption with the shareholding of more than 5%. But for Pillar 2, the threshold is in principle 10%.
Correct, unless participations are held for more than a year, of course. Because dividends from participations that are held for more than a year are excluded from qualifying income or losses, no matter the ownership interest percentage.
And there it gets interesting because this rule does not apply to capital gains, because capital gains are only exempt for Pillar 2 purposes when the shareholding is more than 10%.
This is a risk. Dividends and capital gains that are exempted under the Dutch participation exemption, they may still be included in the globe income.
So while this income is included in the globe income or the calculation, it is not reported for Dutch corporate income tax purposes. And that could of course lead to a lower effective tax rate on the income, which might lead to a top-up tax for Pillar 2 purposes.
Okay.
Yeah, so planning can help if these items are identified in an early stage. So this risk might be mitigated by, for example, restructuring, or by making sure that dividends or equity gains are qualified as excluded income for Pillar 2.
That brings us to another interesting point, also under the participation exemption in the Netherlands, which is the liquidation loss regime.
I can see why that is an issue. So let me break it down. Under the liquidation loss regime, you no longer apply the participation exemption on a loss that is incurred with the liquidation of a participation. This means that you can deduct the loss at the level of the shareholder.
Yes, as long as the shareholder can substantiate the sacrificed amount for the participation.
And here we have an issue or difference with Pillar 2, because Pillar 2 does not recognize losses incurred with the liquidation of a participation. So these are not deducted from the globe income for Pillar 2.
There is a potential workaround. Pillar 2 rules provide for an equity investment inclusion election. This allows groups to turn off the exclusion for certain equity results.
When you make this election, it means that gains can be excluded from the globe income and losses on the other hand can be included. So for example, for the liquidation losses, when you make this election, this loss is also included in the globe income, so it leads to a deduction.
But as you'd expect with the globe rules, there are certain conditions. If this election is made, that means it is done for the jurisdiction as a whole, and the election is also made for 5 years.
And then you need to consider this on a jurisdictional level. So it means that not only a liquidation loss can be taken into account, but it means that when participation, for example, increases in value, that fair market increase needs to be taken into account as well. And the same is when during this 5-year period you sell, for example, a participation and you have a gain on that sale. That will also be visible then in your globe income.
So it's a real trade-off that should only be considered after a 5-year scenario run. It's not a consideration to make lightly.
If this election does not lead to the desired outcome, for example, because you have too many gains that you expect in the 5-year period as well, then you can, for example, also consider not to deduct the liquidation loss in your corporate income tax return.
That would help keep the effective tax rate above the threshold for the application of the CBCR simplified ETR safe harbor.
But that comes with a higher corporate income tax rate, so it's also a trade-off.
Yeah, a careful assessment is essential. You need to look at the whole picture, and every group situation is different.
And that assessment requires in-depth knowledge both of the Dutch corporate income tax system and of Pillar 2. It's a case-by-case study.
So, in short, tax regimes such as the participation, exemption, liquidation loss regime, and the innovation box, they lead to permanent differences and they have an impact on the effective tax rate.
So when using a beneficial Dutch regime, you need to understand what is the outcome for Pillar 2 as well. You need to balance everything, you need to look carefully into the details, and you need the expertise in order to be able to estimate the risk and the outcome.
Absolutely. So Pillar 2 is not only about compliance, it is also about strategy. Wouter, thank you so much for having me.
Welcome.
Thank you for watching and looking forward to the next one.